Good evening, Stonegate audience. I hope everyone is doing great. It has been a fantastic, although very busy couple of weeks here with me at Stonegate Capital. Last weekend, I was with Donna Bauer and her mastermind group. We had a little get-together there in Covington, Kentucky. Had a lot of fun and also learned quite a bit, little bit of which I'm going to share with you tonight. And then this past weekend, I just got home yesterday, as a matter of fact. I went down to Dallas, Texas, where I was joined the Note Expo conference. That happens once a year, has had a couple hundred people there at it, vendors, that type of thing, lots of note investors. Was able to see some good friends and spend some time with them. I was originally going to try to cover some nuggets that I picked up from that here tonight. But then as I started to really put this all together, I realized that was going to take too long. So I'm going to forward next week and give you an update on Note Expo and some of the things I learned there. What I'm going to cover tonight is part 2 of return on investment versus yield. And a lot of people, even professional speakers and such, I've heard these terms really get interchanged sometimes. Well, it's about the same thing. Well, actually, it's not quite the same thing. I did a lot of research because I really wanted to wrap my head around this. And I really worked it out, and I think this example should show pretty clearly the difference and how even the same investment might be different for two different people. So just a short recap of last week. You can watch that if you didn't have a chance to catch it. Return on investment is your net profit divided by your total investment. And the key with that is it looks back in time, okay? Versus when you look at yield, okay? Yield, by definition, you're looking at your return that's projected forward. Okay, yield is looking forward in time. Sometimes it's called yield to maturity, but a lot of times it's just shortened to yield. So again, I was really trying to wrap my head around this. The best way I came up to make it easily explainable was to go over a specific example here. So say that Mike has a house, he's lived in it for a while or what have you, and he decides to sell that house with seller financing. That's the key. If he was to sell it kind of a traditional manner versus someone just gets a bank loan and, bank pays them off in full, then this really doesn't, it's not really applicable. But say that he sells it with seller financing. So instead of getting all his money in one big lump sum, he agrees to take it over time. So in this particular example, these numbers I have listed here, these are typical things that you will see when you use a financial calculator. So the N here, he agrees to sell this house for a total of 20 years, okay? So that's going to break down to your N. You almost always want to put it in your number of months. So 20 years is going to be 240 months. He does some due diligence on the borrower that wants to buy the house, and the borrower agrees to pay an interest rate of 6%. Okay, not bad, pretty good. Say he's a good borrower. If he was a really bad borrower, you might have even held out and really insisted that, he pay you 7 or 8% or sometimes even more than that. He agrees to sell the house for, at least regards to this, the amount of the note is what's key here, for $100,000. If he was really writing a good note, he would get a down payment, say of a down payment of $10,000 or maybe $20,000. So the true purchase price might be more. But what I'm looking at here is the amount that is being financed over that term. So if you plug all that in, and assuming it's fully amortized, so which means that the loan is fully paid off at the end of the term, that comes out to a payment of $716.43. So borrowers say, fast forward. So say the borrower's been doing a really good job. He's been making all his payments and everything. All is going pretty well. But then Mike realizes, this is going pretty well, but, getting $716 a month, it's great and all. But you know what? I've got two grandkids that just started college and have a lot of college bills. Or maybe Mike ran into some health problems and he has some medical bills that he has to pay off. For whatever reason, Mike is now in more need of a lump sum of cash as compared to getting that $716 a month every month. Okay, so someone like me comes along, Bill, and Mike offers to sell me the note. Okay. And of course, he'll probably just want the full amount it's worth, but I'm not really happy with a 6% rate of return. Say I want at least a little bit more. Say I'm looking for an 8% return. So if that's the case, I can't offer him the same price that would be worth. Okay, the future value after 10 years, how much the remaining unpaid balance on that note is going to be $64,531. I really hope everyone can read this okay. I tried my best to fit it, and it took a couple attempts. You can maybe blow up your screen if you need to. But again, for me to get an 8% return, I can't offer him that full unpaid balance. So I'm going to offer him to buy at a discount. I'm going to offer him, if I want my 8% return, I'm going to offer to give him $59,049. Okay? So that will work out to an 8% yield. My yield to maturity is going to be 8% if I just keep that note and, I just keep it until the end. Okay? So again, my yield here is going to be 8%. That is key. So how did Mike do? Remember I talked about return on investment kind of looks back in time. So Mike has now sold this house. He could kind of look back if he really wanted to and see how he did on this as an investment. So what did Mike get? So he got $716 a month times 120 months, right? I said that he sold it after 10 years, so he collected 10 years worth of payments. So that's a total of $85,971. Okay? That's what he had gotten over that whole amount of time. And I already said I'm going to pay him $59,049. That's the amount that I could pay him to get my 8% return. Hope everyone gets that. So if you add those together, Mike ended up with a total of $145,020. Okay? If you go back to that formula there, I'm going to take I'm looking at net profit, okay? So $145,020 minus $100,000, that's going to come out to $45,020. I'm going to divide that by 100,000, which was the total investment. I thought of it that way. That's what it was worth when he sold it. That equals a 45% overall return on investment. But remember, this was over 10 years. Would have been great if he'd done this over 1 year. But again, this was over 10 years. So if you really wanted to be a little bit more specific, if you wanted to really annualize your internal rate of return, you want to adjust for that 10 years, and you're going to come out with a annualized return on investment of 4.5% a year. So some of you might be wondering right now, well, wait a minute, Bill, he was getting 6% all that time. So what happened there? Why didn't he get his 6%? Two major reasons, okay? First of all, when he was getting all those years of payments, this example at least, it's kind of assuming he didn't do anything with those payments, that, he got them and he stuffed them under his mattress, okay? Or he dug a hole in his backyard where they'd be nice and safe, okay? Nice and safe, but he didn't earn any money on that money that he was getting as he got it, okay? So the, money that he got that very first year, he just didn't do anything with. Because all those payments, he's getting some of his principal returned, and then he's also getting interest. So that's the first reason. The second reason was that, again, he sold to me at a discount. So that's why his annualized internal rate of return is only 4.5% compared to the 6%. And some people might be saying there, some of my note investor friends, they can probably do much better than this. Okay, a lot of people can, but not everybody. And what if the alternative was going to be that he sold that house and then he was just going to take the money and put it into a bank? Okay, that bank probably would only pay him around 1%. So by doing it this way, he ended up with a return 4.5 times that. So if that was the case, did this work out well for him? Yeah, it was probably a pretty darn good deal for him. But again, this is just the best example, the best way I could demonstrate that here we got the same kind of thing. We owned that house for the same amount of time, or excuse me, that note, I should say, for the same amount of time, but he ended up with a 4.5% return on investment, and mine would be 8%. So that, my friends, is the difference between return on investment and yield to maturity. So I really hope that all makes sense. You can zoom into this. All the numbers are there. I checked it and double checked it and triple checked it and probably a couple more, quadruple, pentuple, all that stuff. So I'm pretty confident these numbers are solid. So if anyone does have any questions, you're welcome to share them now, or you can type them at the bottom of Facebook, and this will go on my YouTube channel, and I'm going to post this on LinkedIn. So you can post this anywhere, and I should be able to answer. I'd be happy to try to help anybody as best I can. So that will do it for tonight. Thank you, everybody that joined us live. And again, anybody that I met over this weekend, it was great to meet you. Thank you very much, and have a great night. And until next time, that is how you climb the hill. Thank you again. Good night, everybody.